Most people have no idea how to invest in bonds, and they're doing it the complete wrong way. And actually, the stakes become a lot higher when you retire early, and you need to start creating that consistent income for the rest of your life, essentially. So in today's video, I'm gonna show you how to build an ideal bond strategy. And this is the same framework that has worked for our clients that have retired through markets like the great financial crisis. And I'm going to do so by sharing a case study just to show you how to build the right strategy for your own situation. But before we get into that, we first need to understand why even care about bonds. They're boring, right? No, when you retire, I'm going to talk to you about 3 really compelling reasons that I would consider owning them. Number 1 is going to be diversification, right? When bonds and stocks, generally they're pretty negatively correlated, meaning that when the stock market is down 20 to 50%, investors may flock to bonds as more of like a safe haven, and that drives bond prices up while stock prices fall. Now, we're going to look at an example why that's not always the case, and not every bond is equal. Some types may be better investments than others, depending on your goals, depending on the economic climate. And a lot of investors have learned this the hard way, as you'll see towards the end of the video. But number 2 is that most bonds do not crash like stocks do. If we look at a real example of basically comparing the S.P. 500 versus a 1 to 3 year treasury index, during the great financial crisis, the US stock market, or the S&P for example, total drawdown was over 50%, whereas these shorter term treasury bonds really held their value, as you can see in this chart. Again, these things are of a very specific reason in your portfolio, which we're going to talk about. Okay, and then number 3, which we're going to really focus on today, and it's the main goal of owning bonds, and that is to provide a source of income and capital that you can really rely on to preserve your wealth during the inevitable bear markets you will face. It's essentially the emergency fund to your portfolio when you decide to retire early. When creating a portfolio, especially for an early retirement, where we need your money to last quite a long time, the goal is to minimize the amount of bonds you really need to own, but make sure you have the optimal amount based on some of the simple steps you're going to see as I go through this video. Because at the end of the day, we want to help you own the most amount of stocks. That way you can continue to fight inflation and continue to buy the things you want to buy throughout your entire retirement. So now that you understand why we want to own bonds, we're going to go through a case study to see how you calculate the right mix for yourself. And then towards the end, we're going to get more into the specifics on what type of bonds I personally believe are ideal for an early retirement portfolio. All right, so let's meet James and Erica. Of course, they're not real names. James is 55 this year, Erica as well, she's the same age. They're looking to retire next year in 2025. As far as assets go, the at least of what we're going to be able to create income from is going to be they have about $2.5 million. They have a joint brokerage account, so a taxable account of around $900,000. They have a 401k for James, which is about $1 million. And then Erica has her 403b, which is about $600,000. And of course, they have their home here, which is around $1 million. And as far as liabilities go, they do still have a mortgage of around $450,000. So now that we understand what we're working with as far as what we can generate income, let's start to look at what expenses might look like in the first year of retirement. Because once you know the accounts you're going to use, and then you know what you want to spend, we can start to understand how to put together a good, solid bond strategy. Okay, so what you're looking at on my screen now is essentially a breakdown of what income might look like in that first year, right? They want to have net income of just under $10,000, about $9,780. They need to make their base living expense, which is about $7,000, plus their mortgage payment, which is around $2,780. And then they have a little bit of tax here, right? We're going to be taking all these portfolio withdrawals in those initial years from their taxable account, right? They're retiring early, unless we pull something like the rule of 55, where we can access money from their 401ks. We're going to start with that taxable account, and we'll talk a little bit more about that later. Right, they're retiring at 55, so they're going to have to be able to generate this income for the next almost a decade or so before they want to access their Social Security. So those are the 2 pieces of income that we're relying on, and this is all going to make sense as we're starting to put together a bond portfolio for them. Okay, so now that we know we need about $10,000 per month in income for the next 10 years or so before Social Security kicks in, we can start thinking about targeting the amount of bonds that they want to hold in their portfolio. And here's what we know, right? Over the next 10 years, we're going to need to take 6-figure withdrawals. I'm going to pull up the cash flow right here, right? Over the next several years, we got $119,000 withdrawal, $121,000. And this is just kind of a linear projection of what they need in income. So since we know that we want to own bonds as sort of an emergency fund, and we know we want to own the minimal amount of bonds possible. So here's a first layer as I start to think about how much I want to hold in bonds. And what I know is that the average bear market lasts around 14 months or so, but that is the average, right? What happens if a 2008 financial crisis happens and it lasts nearly 4 years? If that was the case, I want to usually target about 4 to 5 years of income in those safer investments in that reserve bucket, if you will. So I don't have to worry about it during that time. I can ride things out. I don't have to sell from stock while they're dropping. So for them, that's around $120,000 per year from the portfolio for the next 4 years. So that's about $480,000, right? Now that's the mathematical side, right? We can run the math, but we're not quite done yet. Because next, this one is a big factor for most people, and it's on the emotional side. Look, I can give you the most optimal amount to own based on some nerdy financial planning, portfolio theory, tax stuff. But what really matters is having a portfolio strategy that you can actually stick with to meet your goals and sleep well at night. And that is why you need to factor in your spouse's emotional tolerance, your own emotional tolerance. Maybe you're married, maybe you don't agree on risk. One of you might be full risk on while the other one is very worried about money. You need to understand your emotional tolerance when, not if, you hit that bear market. If you see your account balance drop, how are you going to react? Will you sell everything, go to cash or gold, cash all your equities? That is the other layer here where you might say, hey, I don't mind taking on more risk off the table and maybe being a little bit more conservative. But if you have multiple account types, where the heck are you going to hold these bonds? Do you hold them in your brokerage account, a Roth, your IRA? This part is one you definitely want to get right. We saw that, like most people, James and Erica have multiple account types. This is a step where before we look at asset allocation, let's look at tax allocation, right? So if we're looking at James and Erica and we're looking at just how they are allocated from the tax location standpoint, they have about 64% of all their retirement nest egg in the tax deferred bucket, right? They've been growing and saving their money in their 401ks for years, and it's been growing tax deferred. So 64% is in that bucket. And then they have $900,000 in the taxable bucket, or 36% of their total retirement portfolio. And in that first year, right, we're going to start taking income from that taxable account because they're retiring early. They've got about $9,920 per month coming from that taxable account in that first year. So what this tells me is that I want to start positioning more tax efficient and stable bonds in this type of account because we're going to start by taking income from that account. So again, based on their account types, what this tells me is that we need to have around $500,000, which is about 20% of their total retirement portfolio, in an account that is available for them to withdraw in a very tax efficient way. This is especially important for someone who is retiring before Medicare. If we have an 80-20 allocation between their total portfolio, we don't just want to go 80-20 in their tax deferred accounts as well as their taxable and their Roth account. That's just not a tax efficient way to invest. Instead, what we want to be thinking about is having more like 55% in the conservative bucket within your taxable account and 45% growth, whereas all your other investments can be more targeted towards growth because we're not going to be pulling money from those accounts, at least until their plan changes or down the road. But the entire retirement portfolio, if we look at it as a whole, again, is more like an 80-20. And of course, that won't be the same allocation forever, but this is just the initial start. So now that we understand how much we need in their total retirement portfolio, which is based on the income they need, we know where to hold them because it's not equal in every account type. Let's start to get strategic here on what type of bonds make up an effective portfolio, especially for an early retirement. Because again, the main goal of the bonds is to be that emergency fund in your portfolio and offset some of the other riskier investments like stocks. So first off, we know what a bond is. It's basically you as the investor loan money to a corporation, a government, or a municipality. And in return, you get interest and they eventually are going to return your principal. But bonds are not risk-free. You need to own the right ones for your specific goals. There's a few risks you need to know about. Number one is credit risk. This means the higher the credit risk, the bigger the risk to you as the investor to not get your interest payments. The lower a bond's credit rating, the higher its credit risk. That means the higher the chance you're not going to get paid back. When I look at building a bond portfolio for clients, I want to have a higher quality bond because it's super important to me that my clients have bonds that are reliable and stable in order to create income. Then there's going to be interest rate risk. Like we talked about, bond prices can also fall due to rising interest rates. So bonds with longer maturities are more sensitive to interest rate risk because there's a greater likelihood that interest rates will rise above the coupon during the bond's lifetime. For example, if we look at TLT, which is a longer duration treasury bond essentially, when the Federal Reserve hiked interest rates in 2022, TLT was down nearly 31%, whereas the S&P 500, which is essentially all stocks generally considered more risky, was only down around 23%. This is why when I build out a bond portfolio for clients, I prefer to have a shorter term bond. Maybe we aren't getting as much yield and maybe it's not going to grow a ton, but it's doing its job of trying to be stable. And the last risk is liquidity risk. And we know that things like treasuries are guaranteed and backed by the full faith and credit of the United States government. So having those type of bonds can help reduce the risk in your portfolio. Now, my preferred approach involves diversifying a total portfolio bond, just like you diversify your equities, and limiting risk. Because after all, again, this is the emergency fund. So holding shorter term, higher quality bonds that meet your financial goals and also factor in the tax considerations, right? For instance, municipal bonds are generally exempt from state and federal taxes, and they're ideal for something like the taxable brokerage account. So many of you that retire early. Then we can have the bonds that don't quite have as much of a tax advantage within your IRA, right? Because you can optimize for tax deferred growth. And you can buy these bonds either by building your own bond ladder for when these bonds mature and constantly rolling them over. But personally, one of my favorite approaches is just investing in simple bond funds and ETFs. That way you're getting institutional pricing and they're going to be automatically reinvesting for you as these bonds mature. So let's put all these principles in practice. If we look at 2022 and we look at a few different bond strategies and we'll compare different ETFs that have different maturities, different durations. Again, this is not an investment recommendation. We can see that if you diversify your bonds, owning shorter term bonds, inflation protected bonds, municipal bonds, and just more of a total bond market ETF, it held up a whole lot better in 2022 compared to picking those higher yield, longer maturing bonds. So now you know the amount of bonds you need based on your income, based on your emotional tolerance. You know not just how much you need, but also what type of account to put them in. And you also know what type of bonds to own in what type of accounts. If we put it all together, this can help give you a smoother ride and the best possible early retirement, because at the end of the day, having an effective bond portfolio comes down to what your income needs today, what your income needs in the future, and how do we set aside enough for you to have to avoid selling from stocks when there is that inevitable downturn. But you can build that and you can have the perfect bond portfolio set up. But if you implement a bad withdrawal strategy and take too much money out when the market is going down, even if you're selling from bonds, it can be a huge mistake if you take too much. And I don't want you relying just on something like the 4% rule. So there are a ton of different withdrawal strategies out there, and you should definitely watch this video that I made on one of the new strategies that we're actually implementing for our clients for their early retirement. You can watch that by clicking right here. Once again, this is Matt Calcagno. I'm a certified financial planner and advisor over here at 1 Degree Advisors. And on this channel, I make videos to help you retire early with confidence. If you'd like to talk to me or someone on my team, you can click the link in the description and we would love to chat with you.